So thank you everyone for joining. I'm Tash. I'm the CEO of Cable. I am joined by Patrick and Chris here. I expect you all know them. I'll let them introduce themselves in a moment in case you don't know who they are. We're here to talk about banking as a service. We have been on a roller coaster over the last 3 to 4 years, but it's pretty clear now that BaaS is not going anywhere. That said, because of all those ups and downs that we've been on, there are now not only much clearer expectations, but some very clear learnings. And Patrick and Chris are both BaaS leaders who have built banking as a service at multiple banks before and are newly at banks and are doing it all over again. So I thought it was a great time to get them together on a call and ask them, based on the roller coaster that we and they have maybe been on over the last number of years, what has changed? What have they learned? How are they doing things differently? So we're going to jump right in. Patrick, Chris, I think it would be helpful for everybody if you gave a little bit of background. Give us the whistle-stop tour of your previous banking as a service experience, where you were, how many programs you were managing, the types of programs, and then we'll get into the real meat of the topic. So Chris, why don't you kick us off, and then Patrick?
Sure. So I started out working with partner banking back in 2013 with BBVA. I was a liaison to Simple Finance when BBVA first partnered with them for the governance process at BBVA, which is very interesting, as you can imagine, with a fintech and a bank governance process. I was also worked with the open platform team, which was their partner banking team, on kind of figuring out from the card side, how do we, build for this? How do we track this? I went from there and did consulting for a little bit. And then I led banking as a service and partner banking for Sterling National Bank. They merged with Webster Bank. And so I led it there for a little bit too. And then I moved on to Coastal Community Bank. And so I was there for a little over a year there, and then managed their CCBX platform. And so multiple different types of programs, whether it be BIN sponsorship or, payments facilitation or lending. And then moved from there to Evolve Bank and Trust for a little bit as their chief process and control officer. Did a lot of work there, building some good foundational pieces to be able to kind of build up what they already had in place and kind of, close some of the gaps and things like that. And then most recently, I'm now at Axiom Bank, leading their partner banking effort. And so we manage, multiple different types of partners, from merchant acquiring to issuing and different types like that. So a large variety of different types of partners and different types of banks with different focus areas. And so I've seen it done in a lot of different ways, I would say. Some good, some bad. And so there's a lot of learnings and everything from those banks, and also from the experience at, with the regulators, and also with working with different folks inside of those institutions.
Awesome. Thanks, Chris. How about you, Patrick?
I feel like I should have gone first. It would have been a lot shorter. So I've only been in the space since 2021. Chris has me certainly beat on years, but I worked at First Internet Bank, where we built and scaled the business from 0 programs in 2021. And then when I left, it was right around 15 programs. The business ended up becoming a sizable portion of the bank's overall balance sheet from a deposit perspective. And then, we supported a variety of different programs, from deposits, consumer and commercial payments, as well as card programs and lender of record programs. So I am now at Stearns Bank as the VP Director of FinTech, running the FinTech business here, where we, when I came here about a year ago, we had about 8 programs. And a lot of the work that's been done over, my year here has been re-architecting the business, streamlining the business, making it driving operational efficiencies and effectiveness, and then just realigning to the new strategic direction of the business.
Awesome. Chris, I think Patrick was trying to make a dig about your age at the beginning there, but I'm going to let it slide. I
Oh
don't know
no, it
about
was
that.
experience
Um,
over age, but
so when I think about the kind of journey that BaaS has been on, I think about it really in three parts. You've got the kind of pre-2023, everything's up, everyone's trying and everyone's jumping in period of time. And then you've got 2023, 2024, a lot of consent orders, quite a lot of banks got out of the space. And then certainly through last year and continuing this year, people doubling down, people actually getting into it who were never in it before, and banks kind of, as you alluded to there, Patrick, recalibrating their strategy ready for future growth. And so I want to start by talking about pre-2023. So the first kind of up with banking as a service. Let's talk a little bit about how banking as a service programs were being built before the consent orders started coming. What was happening? What were banks doing? What did these programs look like then?
Sure.
Chris, go for it.
So, I can jump in. So, I think pre 2023, you had a lot of banks that were sort of, and I don't like this analogy, but I'll use it anyway, building the plane as they were flying it. And so there was a lot of opportunity that banks realized, especially community banks and relatively small banks in size, under 10 billion. They saw a lot of opportunity in the partner banking space. And so they wanted to take advantage of it. And so when you see opportunity like, international payments or, large volumes of payments that you haven't seen before, it's one of those situations to where you get a partner opportunity. And at the time, there wasn't a really good gauge of what the market looked like. What competition do you have? Or, you don't want to lose a deal, especially when it comes with a lot of good deposits and, a lot of fee revenue. And so you wanted to kind of figure that out, right? Figure it out. How do we make this work? How do we, whether it's ACH or wire or card, volume, how do we make this work? And how do we kind of put some processes around this? And so you had folks that were at a community bank, largely seeing relatively small volumes of, transactions and everything. And then also typically not seeing a lot of international or anything like that. And they were building these processes around, transaction types and volumes that they had never seen. And so in some cases, you have banks that brought in some experience in those areas of people that, knew that what's needed, what controls, what changes when you go from 100,000 transactions a month to, 100 million. And so, the other areas you had, let's, get something set up. Maybe it's a little manual, but it works for now. The other thing that you have is these banks kind of had to work with what they had, right? So you have infrastructure that's already kind of preset, and there's not a lot of opportunity to change that, especially short term. And so you had to make do with the vendors they had, the, payments, obviously, probably through the core provider and things like that. And so that's pre 2023. A lot of really good innovation, a lot of really great things were created, really awesome fintechs that, gained traction in the market, and that I think financial inclusion exploded, innovation exploded. But the banks that were really building this had to kind of figure out how to match that kind of trajectory that was happening during that time frame.
Patrick, when you were doing this at First Internet Bank, and your first time around the rodeo, obviously, building this, and FIB's first sort of time spending in this space as well. Was there a sense of like, we'll build stuff as we go? Was there a feeling that banks might, you might get this wrong if you're not careful, and therefore you need to you slow down, take a breath, go back and figure out your controls? How was like the chatter in the room, I suppose, and maybe not specifically at FIB, but in the forums at the conferences?
yeah, I would say that initially there was a lot of the banks that I talked to were of a little bit of the mentality of building the plane as you fly, like Chris mentioned. I think that as you banks get into the space, and even as we did at First Internet, we realized that it was much more complex than just spinning up another line of business that banks have always operated within. So at least what we did early on was to make sure that we engaged subject matter experts across the bank instead of siloing it within like just the fintech business. And that really paid long-term dividends in how we had structured the program. And that was also something that I made sure very shortly after joining Stearns was having those engagements with all the different subject matter areas to make sure that everyone understood and was engaged in the business, and that we weren't operating as some fringe component or fringe aspect of the bank. But there were a lot of banks set up in a way that it was just a fringe component and a just kind of operating on the perimeter. And in many instances, that's kind of been proven to not work well.
Do you think that was one of the biggest drivers of the consent orders, those banks that sort of siloed BaaS as this periphery fringe product and didn't incorporate it? Do you think there's a trend there amongst the banks that got in trouble?
I think there's a variety of reasons. One could be that, another could be that some of the banks that got into the space didn't fully understand what overseeing a program really meant, what having a program manager really meant, and what was entailed in that. And I think that some banks got into this thinking that they would be able to delegate responsibilities for a lot of the functions without, one, validating that, and two, validating that their own policies and procedures allowed for that. So I think that it's a combination of, some operated on the fringe, but even the ones that didn't, making sure that there was alignment in policy and procedure, and then execution against those policies and procedures just may not have been as effective as it should have been.
Anything to add to that, Chris, the reasons why we ended up with all the consent orders in 23-24?
Yeah, I think, I would agree with that. I think the other area would be, even if you include, the risk and compliance, BSA, all of these different areas, if, the personnel you've got in there have been working in community bank, there's a lot of community bank trending situations to where like somebody starts in the branch and then they work their way up and now they're a compliance person, right? And that's great. It's fantastic. And I love to see that within organizations. The problem is that person has never seen the volumes that you're going to have with a partner banking segment, and they've not seen the types of transactions that you potentially could get into. And so I think some of the issues derive from the experience within those banks in certain key areas. And so it's hard to know the controls that need to be put in place. And it's hard to know the different scenarios and nuances you could run into when you increase the volume that amount or get into transaction types that are not common amongst, regional and community banks, unless they focus in that area. Right.
Mm-hmm. Yeah. And I think such a trend then was these, as you say, these very small community banks chasing maybe the security of additional deposits to stop them being acquisition targets, could lead to the consent orders. So 2023, 2024, lots and lots of consent orders started. I'd love to hear from both of you, maybe starting with you, Chris, what the 3 or 4 key messages from those consent orders were.
Yeah, so I think the broad messaging across all of the consent orders is that, number one, you have to have appropriate governance in place. And so the board, management committees, all of these, different folks, and even the regulators to a certain extent, your examiners, need to have an understanding of what you're doing and how you're reporting on that and what your risk metrics are. The second thing that I would say is that the process that you've derived in order to maintain oversight has to be the bank. right? The bank cannot give up program management of the fintech in any form or fashion. And I think that was proven in how the consent orders came out in the specific areas of focus. The other thing that I would say that came out of that, which I don't think was an intended message, but it just came out of it, was that BSA is an extremely important focus area. But I think that was a symptom and not necessarily an intended communication from the examiners, because it was a symptom of a larger issue where you don't have the appropriate oversight and you're kind of pushing everything to the partner and not really completely overseeing that, which caused some BSA issues. And that made BSA a focus. So I think BSA being a focus and I would say, enhanced expectations of BSA that we're seeing now, which prior to 2023, we really didn't see, are really a symptom of that oversight problem and not necessarily an issue with BSA in and of itself.
Interesting. I have lots of thoughts on that, but let's hear from Patrick first and then we'll come back.
Yeah, I mean, I would definitely agree with a lot of what Chris said. BSA was kind of a common note in almost every consent order that came out. I think that a lot of it comes down to something I mentioned previously, which was, alignment of policy and procedure with how it's being executed against, and like Chris mentioned, the governance aspect of that, and like who is performing different functions, making sure that that's clearly defined, and that the individuals that are speaking to the examiners and the regulators can clearly articulate what is happening, and can provide proof and documentation that it is happening. I think across the board is incredibly important. So yeah, I think that's like the primary thread that I saw through all of them. There were other, governance, reporting and board awareness components that came up throughout, but it seemed like the BSA component was the most prominent.
Yeah. There were three things said there that I think are really interesting and we should just spend a little bit of time on before we move on. The first, Chris, you mentioned program management. So one of the reasons why these banks were getting consent orders was, I'm assuming from what you said, their reliance on program management middleware in order to do the work for the fintechs. Can you get a little bit deeper there into the ways that you think that can cause trouble for banks and how banks can utilize program managers or middleware to their benefit?
Sure. So, I mean, whether it's a middleware or whether it's the fintech themselves, so it doesn't really matter whether it's the middleware or it's the fintech doing the actual control. The bank has to also have a control. And I think the missing component that we saw was that the bank said, when it came time for an exam, hey, my fintech has a control. Mm-hmm. And then the question became, okay, well, what's your control? Like, well, it's their control. No. They're not the same. Like, you also have to have a control. And so in a lot of cases, what you had, whether it's a middleware or whether it's the fintech themselves, somebody is doing a check and performing a control on a specific item at the fintech level. And there was not reporting and or evidence and oversight of any manner happening at the bank. And so there was not this, whether it's quarterly or annually or whatever I'm not saying it has to be done daily or weekly, right? We can risk rate these items and say, okay, based on the material risk to the bank, this is how often we're going to do something. But there has to be some form of oversight to make sure that they're doing OFAC checks, that we have transaction monitoring that's occurring, and that there are actually UARs that are being sent, and there's some form of, policy procedure that's tied to that, and that it matches what's actually happening day to day.
Yep.
And that we can validate that. Now, whether that you can accomplish that with the sampling and testing, or whether you accomplish that by getting daily files, or however, that works on the bank side based on the risk and how they, oversee that control. The bank's control is the oversight of that function.
Got it. Yeah, that makes a lot of sense. The reason we started Cable, so thank you for that easy plug. The Patrick, anything to add to the program management point before I jump into the BSA point?
Yeah, I think um, there's been a lot of threads around the program management having like a BaaS platform or middleware as a program manager that manages sub programs. And I think that, people have very strong opinions on it one way or the other that you can or can't do it. I think the only thing I would say is it really comes down to what Chris mentioned. Like, even if you have a middleware provider that is a program manager, it's like the bank can't just pass off all the controls to that middleware provider. The bank has to still have controls in place. The bank has to show that they're effectively overseeing the programs. And it is possible to be successful having a middleware provider, provided you have those controls in place and that they are effective. It doesn't have to be that every fintech has to be a program manager in that instance. It could be a middleware provider in some instances if you have the right structures and governance in place around it.
Yeah. It's been interesting as well watching the evolution of the middleware players. They all sort of started out doing a lot of the program management, and there's maybe only one left that does that now. The vast majority have come out of that space.
The only thing that I would add to that is that I don't want to say it's going to be more complex to do it that way, but it is going to be very different. And there's a lot to be said about the relationship and how those contracts are constructed, because when you have a fintech that's partnering with a middleware and doesn't have a direct relationship to the bank, what teeth does the bank have to enforce their policies, regulations, procedures, all of these types of things? So you have to pay a lot of attention to how those relationships work to make sure that when the bank needs something from fintech A that's partnered with the middleware, they can get it and get it in the time frame that's expected.
Yeah, that's a very key point. We still at Cable work until very recently work with some banks who have middleware, and the banks did not know the fintechs themselves. And that's not really our job, but we definitely had conversations around, okay, you really need to have this direct relationship. And if the middleware is unwilling to introduce you and to give you that communication line, then that's a middleware player that probably you don't want to be working with. I want to double click on the BSA point being a symptom, not a cause. I am interested if either of you think that program management and having a third party who goes and gets the deposits, the customers, or goes and finds the lending opportunities. Do you think that structure is inherently more risky from a fraud and financial crime perspective? And not to lead the witnesses, but when I even now think of, for example, Contigo, right, just a recent example, I have no idea whether the founders of Contigo started that company in order to try to evade sanctions, but it certainly was a lot easier to do that than if it had just been JP Morgan or if it had just been Checkbook trying to do that. And so I'm interested in your opinions of whether you think this is inherently more risky from a BSA perspective, or whether actually it's not, as long as you have the right controls in place.
It doesn't have to be. So I think whether it is and whether it has to be are two different things. Mm-hmm. So as it stands right now, I think we can clearly see that it can be, for sure. I think that, to your point, having the proper controls in place. But the other thing that you have to realize with a lot of these middleware players too is that there's a lot of volume of fintechs looking for bank partners and of different flavors of different. They want to do different things. They want to do different transaction types. They have a new loan they want to do. I mean, there's tons of different things that are out there, and there's just not enough sponsor banks to go around. I mean, and not only with not enough sponsor banks, but the risk appetite of the sponsor banks isn't such that they would support the broad, spectrum of fintechs and the products and types of things that they want to do. And so the middleware players come in and they say, okay, we'll support you. We'll take kind of everything in, and then we'll kind of find partner banks in the back end, right? Whether it's new partner banks coming on or whatever. So a gap in the market was solved with them coming into play and saying, hey, we'll support all of these. Mm-hmm. And so in doing that, though, the bank needs to, again, have the proper controls in place to say, okay, this segment is not something where I'm comfortable playing, or I'm going to have these types of controls in place and I understand the risk in this specific area that I'm going to get in, like crypto or international transactions or what you're talking about, like that all of those kind of components, the bank has to have the experience and the controls in place to partner with that middleware service to be able to provide that and to really oversee that in an appropriate manner.
Mm-hmm. Patrick, anything to add?
I think Chris covered it pretty well. I mean, a lot of it comes down to the oversight of those programs and, defining you as a bank, defining what your strategy is, what your risk tolerance is, sticking to that, and making sure that you're effectively overseeing your programs are sticking to what they've been approved to do.
Yep. And that leads nicely onto the point that you made, Patrick. One of the reasons why consent orders were being given was this sort of misalignment of policies and procedures. And this was a really interesting, unexpected benefit that we found our customers were getting from actually using Cable, which is, if you've got a fintech, you ask them to send you their policies and procedures, you agree on everything, you ask them to include a few things that are in your procedures that you need them to be doing. And then they just kind of say, yes, we're doing it. And then you ask for a sample maybe 3 months later and you go ahead and you try and determine if they're actually following those procedures. Through 100% testing that is automated, because you have to take in the data to evidence each of those procedural controls, you actually learn at the outset of that relationship whether the fintech is collecting the right data and doing the stuff that they've said that they're doing. And I'm interested in, Patrick, Chris, if you've had this experience of, you've been working with a fintech for a while, you absolutely thought they were doing this thing that they said that they were doing, and they actually just weren't. And you had to then go ahead and do a bit of remediation and get them to do stuff. And if you have seen that, aside from using Cable, what are the ways that our viewers, the people on the webinar, can sort of take away to make sure that they are satisfying that issue going forward?
Yeah, I think how I've historically run programs is there's very much like almost 100% QC, if not 100% QC when they're onboarded, of all the activities that they do. So instances like that have usually been caught very early on, and remediated relatively quickly. I haven't run into an issue that it's been materially different than what I would have expected as a result of that. And again, that comes down to like controls that are in place and oversight that's being effective.
Mm-hmm. Yep.
Okay. Yeah, I think for me, obviously come into a few different institutions that already have programs that were running, and so coming in and kind of filling gaps and working in different areas to build better foundations. I think one of the ways that you realize that is realizing a control gap and implementing that control gap. Mm-hmm. The other thing that I would say is that in my experience, a lot of times it isn't that we find out they're not doing it. It's we find out there was a very different definition of what doing it meant.
Yeah.
And so the fintech said, oh yeah, we can do that. And then we were like, cool. And then it comes to control time and we look at it and we go, you painted all these blue and they clearly need to be red, right? Like, it's a very different definition of what the control and actually performing the control meant. The other thing that I would say is that there has to be clear expectations from the bank to the fintech partner. Mm-hmm. You have to make sure that you have your ducks in a row so you can clearly communicate everything that you expect the fintech to do and the data they need to provide and the reporting they need to provide you so that you can perform your control. Because a lot of times what happens is either number one, there's not a very clear definition of that, or the bank is sort of the building planing as it flying it situation to where you're constantly coming up with something new that the fintech needs to provide you because you're discovering more and more control gaps. And both situations are not great. not great for the bank, but they're also very not great for the fintech because they are also running a business, right? So we have to keep in mind that they have staffing, they have resources, they have capital, they have all of these same type of things a bank does. So they don't want to have to change their processes or provide a new report or change code every time they turn around. And so we have to make sure that we're very intentional with the way that we build the programs and communicate that and those expectations to the partner.
Yeah, absolutely.
Yeah, I'd like to add onto that. Like that is a very real thing if you're trying to build the program as you go. Like, the knee-jerk reactions, uh, oh well, we now need this, and not having much consideration for the fintech and the end users necessarily in those instances. That's there have been times where I certainly have experienced that, and it gets to be challenging because you have to balance your regulatory obligations and your oversight obligations against customer experience, and making sure that you're balancing the two effectively. And I think ultimately, like, documenting why you made whatever decisions you made throughout the process, and how you're road mapping out how you want to execute against, maybe bringing a program into more strict compliance with certain components. Um, that becomes very important for the storytelling aspect of how you actually create explainability to regulators.
Yeah. Yeah, that's a very good point. To wrap up this period of time in our BaaS journey, so the consent order period of time, I would love to get your thoughts on, I guess, what makes a bank a good candidate for being a BaaS bank. So with all of these consent orders, we saw some of those banks that received consent orders weather the storm, stick it out, they're still going. I'm thinking of like Thread Bank and others. And there were other banks who received consent orders, like Blue Ridge, obviously the first big consent order that everyone was talking about in this space, that did decide to leave and stop doing banking as a service. And I'm interested if you both have in your head like a clear shape that a bank should be if they're going to get into BaaS, or whether it's actually any shape as long as you have the controls. Keen to hear your thoughts on that. Why don't we start with you, Patrick?
Yeah, I think it makes it a lot easier for a bank to get into this space if you're under 10 billion in assets.
Yep.
That certainly helps from a Durbin exemption perspective. It's I think that any bank could get into this space, but you need to really understand why you're getting into this space. I know that, when I first was getting into it, it was the possibility of lower cost deposits. That hasn't particularly borne out because the programs that are wanted and are desirable from a bank perspective, that have less issues and aren't, in a very early stage startup, like, that costs something to run and operate and to engage with. But effectively understanding why you're getting into it, what you're trying to accomplish for your bank as a result of getting into it, is incredibly important. And then driving, like, making sure that there's a strategic alignment between the bank and the line of business, executing against it, from my perspective, is pretty critical. Like, I think that you shouldn't be getting into the BaaS space if you're looking to, target an entirely different business segment than what your core bank already does, because I think Chris mentioned earlier, like, the staffing component of that becomes very challenging. If you don't, know what you're looking at, you want to do international business, but you've never done it for your core bank, that may not be the best avenue to try and take. So yeah, I think any bank could do it. If I were doing it again, I guess I should say, it would be like focusing on operational efficiency and effectiveness, and keeping as low of a cost structure as possible to make sure that you're like automating as much as you can, including, a lot of the data components, and making sure that you're just have everything set from day one so that it's entirely scalable from there, versus, building the plane as you fly it.
Yeah.
Yeah, I would agree with all that for sure. I think the only thing that I would add is that if you're going to get into it, you need to have buy-in. And a lot of that comes with those strategic discussions of why are we doing this? What's going to be, the output of this results based, strategic thinking. I'm a product guy at heart, so I always go back to the design thinking and jobs to be done model. But I mean, it's really thinking that through and saying, okay, we either want more deposits or we want X amount of deposits and Y amount of fee revenue and things like that. And then driving backwards from there about how you would get there. But in order to do that, you have to build a business case for the investment because it's not something you try, right? You either do it or you don't, and it's going to require investment no matter which area you get into, which segment, if it aligns with the bank or doesn't. The volumes you're going to experience are going to be markedly different than what you have today. So you're going to have to invest in infrastructure and people and things like that, right? You can do it in a low cost manner and automate as much as you want, but you're still going to have to invest in those areas. So the board needs to be behind it. I think a lot of times what ends up happening is the bank initially gets into this as this is going to be an easy win. And when it's not an easy win, that's when you have folks kind of backing out and saying, okay, maybe this isn't something we should do anymore.
Yeah, an interesting, expensive experiment. You said something there, Patrick, that I want to pause on. You mentioned, when people started getting into this, they were mostly after the low cost deposits. And that model maybe has changed a little bit, which makes sense, just like thinking through the number of really, really big fintechs. There are not that many of them that have a lot of deposits. And they might spread their deposits across 3 or 4 different banks. So the volume of deposits that an individual bank is going to get is going to be lower. Presumably, you have to price really competitively to win those really big programs. So if the low cost deposit is not the main attraction now, I guess 2 parts to this question for you. The first part is, does that change things for the larger banks? If you are bigger than 10 billion and you're not benefiting from Durban, what is that? Do other sources of revenue actually become more appealing? And then I guess secondly, for those banks that are still small, that are getting into this, what are the other reasons why, or what are the other revenue streams that would really be exciting for them?
Yeah, I think, depending on the type of activity that you're doing, some programs may just need a bigger bank. I've worked with programs previously that wanted to have a globally systemically important bank as part of their portfolio mix because of the size of customers they deal with. And, that's just going to be part of the decision matrix for them.
Yep.
In who they partner with. I think from bigger banks that get into this space, there's a variety of fee income opportunities. I think how I think about deposits now, even as a smaller bank, is a little differently than I did when I first started getting into it.
Mm-hmm.
It's much more of a liquidity mechanism, being able to move money on and off balance sheet as needed and managing liquidity once you reach, a point of having excess deposits. I think the avenues of fee income from loan origination fees for lender of record programs or loan origination programs, whether you decide to hold the loans on your balance sheet or not, because this business has a potential to be a bank within a bank. You can bring in deposits and then you're using those deposits to fund lending within your business potentially. So that becomes what you're managing to. And some of the yields that you may find in the fintech business are better in many instances and have more risk mitigation to them than the core bank business may. And that's something that I've experienced previously as well, which is, if you have a program manager that you're running a loan origination program for, there's loss protections, there's collateral accounts, reserve accounts to cover a lot of the potential losses in that program. But you're still generating, origination fees and carried interest on however long you're holding it on your balance sheet pre-sale and things of that nature that can be very lucrative for a financial institution.
Our friend Mark Rayberger is having a little conversation with himself in the Q&A chat, but it seems like you covered his answer, Patrick. But a reminder to everyone listening, if you have any questions, let us know. Post them in the channel and we'll get to them. Okay, so that's really interesting. A lot of different opportunities of fee income, a lot of more just like core banking stuff. Oftentimes, I think when people talk about banking as a service and people get excited about it, it's like this whole new way of doing banking. But what I'm really hearing from you there, Patrick, is doing this a second time round, you're much more attuned to the bank has a sustainable, profitable business model, and banking as a service is a tool to optimize many of those different levers, not just deposits. And actually the mature way to think about this, if you're getting into this the first time or if you're doing it again, is really what are all of the ways that this tool can help the bank increase its margin? And that might not just be deposits. That might be thinking about balance sheet. It might be thinking about interest before you sell loans. All of those things, which are just like core banking things that you have to do to run your bank.
Yeah, I mean, I think of banking as a service and embedded finance as just another delivery mechanism for banking, right?
Yep.
I like to tell people we're not rocket scientists here. We're just repackaging banking in a different way, and offering very similar products and services through different delivery channels. And our role in that is slightly different, right? It's more of an oversight and governance rather than a first line, branch banker sitting, opening a deposit account. We're doing it at a very different scale, but it's still the same function at the end of the day.
Yeah, I think that's a sensible way to be thinking about it. So now everyone is, doubling down on banking as a service. Hopefully they're thinking about it in this mature way. Some of the tools that can be used just to strengthen the bank more generally. What have you both seen in terms of how banks are thinking about controls? Are they different? Are there more? Are there less? Is there new technology now to help somebody who's listening to this? What should they be doing from a control and a tooling perspective? Chris, why don't we jump to you?
Yeah, so I mean, I think one of the main things that you have to really focus on internally on the risk and compliance side, especially in the controls piece, is materiality. What is a material risk to the bank and what is not? You could look at a lot of different things, and some banks do, but not all risk is created equal, right? So there's two main components to that. Number one, partner banking in and of itself isn't high risk, because if every partner is a high risk, then nothing is high risk. So we have to delineate and have a risk framework that takes that into account. Because what a lot of banks will say, and their risk and compliance books will say, is, well, every fintech is high risk automatically. And it's like, well, that's not really, like, if we approach it that way, then it's the high risk moniker is meaningless, right? So we have to get some level of risk and evaluation. And that comes along with understanding what materiality is to the bank based on the risk appetite, based on, the strategy of the bank, and what would pose a risk based on the product that's being offered, whether it's ACH, wire, card, whatever it is, right? Deposits you're holding, reserves you're holding. I think all of those things have to be taken into account to say, if we do nothing, what is the worst thing that could happen? Then we have materiality. Once you rank materiality, then you can say, okay, these are the critical, high, moderate, whatever areas that we're going to pay attention to. We're going to do this daily. We need 100% coverage on this thing. We need to do this weekly. We need to do this monthly, quarterly, what have you, right? And then here's what the remediation steps look like. Here's the issue management that we're tracking. And then that's per partner, right? Because every partner is going to be a different risk. They're going to pose a different type of risk depending on, the products that they offer. The other thing too is to make sure that if you're reliant on the partner for things, that you clearly communicate that and get that data into you. I think one of the hardest parts, at least to me, that I've experienced in doing that, and I'll do a shameless plug here for NEPA and Themis, is managing all of those partnerships under one easy to access and manage place where I can be prepared for an exam to give evidence of the controls that we've put in place. And so it's not to say that Themis is the only place you could do that, but we've had a very good experience with using Themis and implementing their modules and being able to manage everything in one place and be able to report and turn over that to the examiners, during exam time, but also to manage issues and to be able to communicate back and forth with the partners and, things like that. I think that managed through email and files saved on an internal drive somewhere, and then maybe some, GRC system that compliance and risk uses, it becomes very disjointed. And so when you get to exam time and you're like, okay, where did we put that spreadsheet? Let's deliver that over to the examiners to have the evidence that somebody actually looked at this monthly, like we said we would do in our processes. It becomes very difficult. So number one, look at the right things. Make sure you're not just looking at something just because you think you should. Is it a material risk to the bank or not, and why? And that also feeds into what Patrick said earlier, where your risk and compliance folks need to be able to get into the room with the examiners and explain the why behind what they're doing and have that ready to go, because it's really taking it to heart internally and saying, I had a part coming up with this and I can explain it. And so, having all of that in one place and being able to turn it over and then looking at those key areas of risk, I think are the main things to me that we should look to going forward.
Mm-hmm. Patrick, anything to add?
Yeah, I think I'll also help with shameless plugs. I think, we've implemented Cable and doing 100% testing of BSA. Like, the things like that are going to be ultimately table stakes in this business. Yeah. When you operate at scale, when you have multiple fintech partners, it, instead of doing sampling, which could, you could catch a sample, whatever percentage sampling you're doing, you could catch something or you could not. And there could be underlying issues that are just not identified. Whereas if you have systems and tools in place that can give you 100% testing, it points you to the direction you need to be focusing your time on, rather than just spending time saying that you're doing testing. I think more and more components of the oversight process, because a lot of what we end up getting really is ultimately data. We get data should be able to be moved from one place to another, be able to automatically assess what is happening in whatever section you're looking at or whatever component you're looking at, and be able to create alerting around the items that need to be looked at. Because ultimately, we need people looking at the things that actually matter versus, looking at things just to say and be able to tell our regulators that we're looking at things. We need to, Chris mentioned identifying the risk and the materiality. Like, this is what tells you where the materiality is. The better testing and the more coverage you're able to get on your testing, like, that tells you where the material issues are. And that points you to where you need to be making either adjustments or, maybe de-risking a program, whatever it may be. Ultimately, that's what it comes down to for me. And that's how I like to structure the business.
Yeah. All right. That both some very good ideas there. And hopefully people are taking notes of ways that they can set this up going forward. We're almost at time. So again, just if you have any more questions, drop them in the Q&A. But I want to wrap up by getting both of your thoughts on what banking as a service really means for banks longer term. Is this how the smaller banks avoid being, snapped up by acquirers? Is this a way that they build defensibility? Does it fundamentally change what a bank is? Or actually, maybe, Patrick, to what you said earlier, maybe it's just, strengthening banks. Keen to hear your thoughts on, I guess, the future of banking, given banking as a service really feels like it's here to stay. Patrick, why don't we start with you?
Yeah, I think that the banking landscape is changing very dramatically in a very short period of time. You have things like stable coins, tokenized deposits. You have a lot of different ways for people to hold and store funds and store money, that in some instances are taking those dollars out of the banking system, and out of community banks. And, it's, yeah, so you can build better products and services, or even partner to get them through banking and as a service relationships. Um, I know that from my standpoint, most community banks don't have multi-million dollar marketing budgets or hundreds of millions of dollars to spend on marketing to get dollars in the door. Some of the fintechs we partner with in this space do, and that makes it a lot easier for us to gather those deposits and build defensibility in the banking business. Ultimately, I think there's going to be consolidation in banking even more than what it is today. But there's going to be new entrants that come in. I've had some conversations with other bankers over the past several months, and it's, bankers wanted a deregulatory environment. We get a deregulatory environment that now has increased competition. You see entities like Airboard Bank coming around that is going to increase competition, and really take it to banks. And now it's up to banks to actually compete against technologically potentially superior entities that have charters and are coming after those deposits as well. So, I think banking as a service is a very logical and reasonable way for community banks to continue to build defensibility in their businesses and sustainability in their businesses.
Yeah. Chris, anything to add?
Yeah, I agree with pretty much everything that Patrick said. The one thing that keeps bugging me and kind of eating at my brain as we've been through all of this is that there's a broader question here that all of the history we just went through kind of poses, and that's how do banks innovate with the regulatory bodies alongside them? And I think that is a question that hasn't been figured out and that hasn't really been pushed prior to this day and age with the situation we're in now and consent orders and formal agreements. What you saw prior to 2023 was essentially banks innovating with partnerships with fintechs. A lot of innovation occurred, and innovation requires failure. And so you just need to fail fast and, mitigate the collateral as much as you can as far as, the damage is concerned, and then continue to innovate and iterate on, what you're doing till it gets better and you have something that clicks, right? I think, any entrepreneur will tell you that their first business probably failed, or they went through multiple iterations of, this worked, that didn't work. How do banks do that? I think is the real question. How do banks do that with regulators that the best answer we get normally is non-objection, right? And so how do we move past non-objection to collaborative discussions with examiners where we say, hey, we want to do this new thing, or we want to partner with this group to do this new thing? How do we do that in a manner that is going to be accepted-ish, right? And acceptable. And what are areas you think we need to put up some guardrails so that we can manage those risks and protect, consumers, obviously, and businesses and in the end customer at the end of the day, while still understanding that this is an iterative process that we need to go through. And that's one thing that keeps digging at my mind is that, how do we get to a place to where we can sit in a room with examiners and collaborate and be able to get true feedback rather than just non-objection?
Yeah, I think that's a really good point. And I don't know how that happens. It feels like it has to be a regulatory change. So very, very good point. Interesting thing to think about. We've had a couple of questions come in. They're really, really good questions, very practical. So I'll pose this one to you, Chris. Should the bank partner choose the audit vendor for the fintech partner or accept the audit vendor the fintech partner chooses?
That's an interesting question. So in my opinion, you should approve the audit partner that the fintech chooses, but that approval should accompany a set of standards that you say, hey, the audit has to be done by reputable company in the space, that has to be an area of expertise that they have, and they're, obviously qualified to audit. You can't get mom and pop's audit LLC to do an ACH audit for you, right? Like, I mean, you need somebody that has experience in the area. And so I would say if you're going to choose the auditor for every fintech, that gets very tiresome and labor intensive. And you're also going to turn away some fintechs because they want to use who they've always used. But you should have that standard that you're sticking by to say, hey, this is the standard we need to validate before we will approve that auditor to do the audit for that specific item.
Yeah. All right.
I'd like to add one thing to that. Also, make sure that you're reviewing and approving the scope of the audit, because they may give you a reputable auditor and then not cover the full scope of items that you may want or may be required. So make sure you're not just approving the auditor, but the scope of the audit to be done.
Yeah,
100%.
very important point. Yeah. The next question, Patrick, let's start with you. What additional controls or safety guardrails do you typically require in a bank partnership with a foreign fintech versus a US-based fintech?
That's a good question. I don't. We do have some foreign-based fintechs that we work with here at Stearns. I think a lot of it is focused on a lot of the maybe additional guardrails would be additional verifications of international bodies, making sure that if someone's operating in the UK and they have an e-money transmitter license, like validating those licenses and seeing if there's any issues that they've run into with their regulators overseas. I think understanding the data storage aspect is pretty critical as well. If you're going to have customer data that runs through those foreign fintechs and is stored overseas, having the right controls in place and verifying that you can do that, not just with your policy and procedure, but also applicable law and regulation. Those are some of the first things that I would look to in that regard.
And some of the things that come to my mind are around OFAC screening on the transactions, making sure that any international payment has that, as well as everything that you mentioned there, Patrick. And something that has been interesting to me moving from the UK with regards to beneficial ownership. If you are banking fintechs that have businesses, some countries have publicly available lists of companies with all the directors and beneficial owners listed out, like the UK. And if they don't, really making sure that you understand the ownership structure beneath any of those businesses, I think would be something that would be particularly tricky in an international relationship. Chris, anything to add?
Yeah, I think it's difficult to do without a U.S. presence, right? So if a company doesn't have a U.S. presence that's established here with all of the appropriate licensure and everything that goes along with it, it makes it very difficult. The other thing that I would say, depending on the transaction type, travel rules also comes into play in a lot of instances, depending on, where they play and what they do, which depending on, again, your experience in your back office, you may or may not have experience with travel rule. And so it's definitely going to be, I see the follow-up to the question, is it realistic for a foreign fintech partner to work with a U.S. bank today? I think the list of banks you're looking at is pretty small. And so you're going to have to find the right one.
Yeah, I would agree with that. And I would also say, from a bank side perspective, understanding that if you're working with a foreign fintech and all the associated staff supporting the business is overseas, there's a lot of time difference considerations that get brought into play. There's a lot of asynchronous communication versus synchronous communication. And it makes it a lot harder for you to effectively oversee a program. So, like Chris said, there's probably not many banks that do it because it is much harder for the bank to do and effectively oversee.
Yeah. Awesome. Well, we are at time. This was fascinating. I think we covered a lot of ground. Thank you so much, Patrick and Chris, for joining us today. If there are any more questions, feel free to follow up with me, Natasha at cable.tech. We'll be sending the recording out to everybody who signed up for the webinar and sharing some insights over the coming weeks as well. So thank you so much, Patrick and Chris. Really appreciate it. See you soon.
Thank you.